Okay, in this video we're going to take you through the account types in the chart of accounts. Your chart of accounts are the accounts you set up in QuickBooks to report the financials of your business, your profit and loss, your balance sheet, etc. Every business has a chart of accounts. You need to understand the account types so that you can accurately read your financials. Also, keep in mind these accounts should be a high-level sums of data. You don't want to put every item or service you sell on your chart of accounts, or as we've seen sometimes, every vendor. Those should be items, and the items point to will sum on your financials. You can always run subledger reports like sales by item or sales by purchases by vendor to get that detailed information instead of running it through your chart of accounts. So we're going to go to lists and chart of accounts, and I will select account and new to take you through the account types you can set up in QuickBooks. Okay. First, we have income. This is pretty obvious. Income is your revenues from your business activities and the first accounts you see on your profit and loss statement. Some examples of income include repair income or product income for an HVAC company, right? So the HVAC company goes in and repairs your AC system, or maybe they sell you a new AC system. A nonprofit company could have donations, membership dues, grants. These are different income examples. A manufacturer may have product sales, and they might have also customer discounts, which would be an income account type, but maybe show a negative number, right? Because you're giving money back to the customer. So a contra income account is what that's called. Okay. Next, we have expenses. These are also on the P&L. These are costs related to the overhead of your business. Expenses should be costs you will have regardless if you have any sales. So some examples are rent, insurance, bank fees, advertising costs, indirect labor or admin labor. As an example, a restaurant, right, they have to pay a chef even if no one shows up for dinner. It's not a direct expense. We'll talk about direct expenses a little bit more when we get into cost of goods sold. But expenses, again, they're pretty obvious. So next we have fixed assets. These are a balance sheet account type. Fixed assets are equipment, machines, software, or other assets that help run your business, so not inventory parts. Again, we should not have an account for every vehicle, equipment, or computer we buy. Instead, the individual items should be set up on the fixed asset item list and roll into a few fixed asset item accounts like computers and equipment, furniture and fixtures, softwares and vehicles. So you'll see here that we have a fixed asset item list. That's where you put the details. And again, those details would run into a fixed asset account. That is a high-level account. You could most likely see accumulated depreciation as well, which would be a negative number in the fixed asset area, or again, a contra asset, right, negative. A fixed asset account type, they're long-term assets, and every company should have a threshold for what the fixed asset is compared to what should be expensed. So most customers under $1 million in sales have a fixed asset threshold of $500, but of course you should check with your CPA to get yours. So if it were $500, any one item used to run your business that costs more than $500 should go to fixed assets. And if it's less than $500, it should go to expenses. The idea behind these are that they have a life of more than a year. So an example is a laptop. You purchase a laptop for $900. It has the life of 3 years as determined by tax rules or tax law. You have to spread the cost of the laptop over 3 years by depreciating the asset. Now, of course, there are always some, 179 and other things that you have to talk to your CPA about, but when we're setting them up, we want to make sure that we're pointing them to the asset accounts instead of the expenses. Okay, so again, with fixed assets, some examples: computers and equipment, high-level generic. If I buy a laptop, the laptop goes in on the fixed asset item list and then points to computers equipment account. Okay. All right, the next account type is a bank account. This is a balance sheet account. Your cash accounts should be bank accounts, obviously. Other accounts that could be bank account types are PayPal, which is actually a cash account, petty cash, cash in drawer, or maybe a barter account where you pay your vendor and the vendor, or you don't pay your vendor, but you pay them by giving them services or products, or vice versa. Okay. Debit cards pull from cash accounts, all right, from a bank account generally. So if it's a credit card, that's different, but debit cards are generally dealing in cash, right? So they would be pulling from a bank account type. Also, this is one of the account types that you can connect to an external bank, okay? So you want to make sure that if you are trying to connect to your bank account, obviously you need to set it up in QuickBooks as an account type of bank. Next, we have loan. This is actually not an account type, but describes an example of one. And I actually feel that this is incorrect, the description here, because if I select loan and then hit continue, see, it takes me to an other current liability. And generally, most loans are long-term, what I've seen. And if it's long-term, meaning you're going to pay it back in over a year, it's going to take you over a year to pay it completely off, then it should be a long-term liability. Okay. So my advice is not to choose loan for your loan accounts. All right, anyway, moving on. Let's go ahead. Okay, and then we have credit card. This is a balance sheet account under current liabilities, since most credit cards are expected to be paid off within a year, meaning the balance is paid down, right? You buy something this month, you pay it off next month, right? So you're paying off what you purchased already. You can also connect these account types to external sources like American Express to download your transactions into QuickBooks, so using the bank feeds. If you're using the transaction type credit card, you of course have to have a credit card account type set up. So if you're looking under banking, you don't see enter credit card charges, that's because you don't have a credit card account type set up yet. All right, next down the list here we have equity. This is a balance sheet account type. The accounting equation for every business is that assets equals liabilities plus equity. So equity is the accumulated ownership interest in your business. Examples of equity accounts that you should see in there include paid-in capital or contributions, distributions, retained earnings, accumulated equity, maybe some stock. So those are some examples of things that we usually see in the equity section. Now down here in the other account types, these are actually the ones that we use probably the most besides income and expenses. So it's funny that they put them in as other, but first we have accounts receivable. This is a current asset on the balance sheet. If you're going to invoice your customers, you should have an accounts receivable account set up. In QuickBooks, you must use a customer when posting to this type of account. So things like allowance for bad debts, right, which is usually like a lump sum guesstimate of how much we expect. We don't really know what customer is not going to pay us, right? So we don't really have a customer to point allowance to bad debts towards. So allowance for bad debts is generally, we recommend not an accounts receivable account type, but instead an other current asset. I rarely recommend using more than one accounts receivable account. However, there are a few instances where it's warranted. One example is if you need to keep two separate invoicing number increments. Like your Dallas office invoice numbers start with DAL, like DAL 001, 002, 003. And then your Austin office invoices start with AUS, like AUS 901, 902, 903. And you want to keep them in separate increments. So anytime you post an invoice to the Dallas account or Dallas accounts receivable, it will pick up Dallas 004, 005. But if you change the accounts receivable type or the account on the invoice to say it's going to the Austin accounts receivable, it'll pick up that numbering scheme, Austin 904, 905, 906. Okay, so having two separate accounts receivable will allow you to use the system to keep that, what number's next for this particular accounts receivable account. Not something that people have very often. So again, if you're thinking about maybe having multiple accounts receivable types, might be an opportunity to give us a call. Next, we have other current assets. This is a balance sheet account type. These should be receivables or assets we expect to collect within 1 year. Okay, examples of these include employee receivables, prepaid expenses, right? Those are things you usually see in there. An other asset, also a balance sheet account type. These are assets we are going to be holding on our balance sheet for over a year. Okay, so they're not going to be paid down within the year. Some examples are long-term loans to officers, security deposits to your landlord, or long-term investments. Then next we have accounts payable account type. This is a current liability on the balance sheet. Much like its counterpart, accounts receivable, accounts payable requires a vendor name to be tied to the transaction posting here. So most of my customers have one accounts payable account. One example of a customer who has multiple accounts payable account types is a property management client of ours that has pass-through expenses for their customers. So the property manager pays utilities on behalf of its customer, right, of its property owner, and then charges the property owner for 100% of that utility expense paid. Since this accounts payable really isn't owned by the property management company, right, it's just a pass-through, we have set it up as pass-through accounts payable. And then they have a separate accounts payable called operations accounts payable. So they know how much they owe as a company versus how much they owe for their pass-through accounts. Okay. All right. Next we have other current liability. This is a balance sheet account type. These would be short-term liabilities, meaning we're going to pay them off within a year. Some good examples are payroll liabilities, sales tax, current portions of loans, and customer deposits. Good example. Okay. Next, we have long-term liabilities, a balance sheet account type. These would be things that take longer than a year to pay off. Examples are mortgages, long-term lines of credit, vehicle or equipment loans, and maybe payables to owners. If you are using the loan manager in QuickBooks, okay, you have to have, so again, this is where it's confusing, right? Because this loan feeds to a other current liability, but the loan manager, if you're going to use that, you have to have the account set up as a long-term liability. It's a little confusing there, but just so you're aware. If you're using the loan manager, your loan has to be set up as a long-term liability. All right, now we head back to the profit and loss with the cost of goods sold account type. This is also where cost of services sold would go. This account is meant for direct costs that relate to income, meaning you sell $1 of your product and that has a cost associated with it. So it costs you 50 cents to make the product, you sell it for $1 or whatever your markups are. One example is if you buy and sell baby pacifiers. This is a product. You do not recognize the cost of the pacifier until you sell it, and that cost is a cost of goods sold. Another example in the services industry is a plumber with technicians in the field. He sells plumbing services, and the cost of those services would include labor of the technician and any parts that are used on the job. These are direct costs. The importance of segregating these costs from your regular expenses is crucial. You want to know how much it would cost you to keep your business running, meaning all the expenses or operational costs, and then how much it costs you to make sales, so for your direct or cost of goods sold expense types. Also in some states, like here in Texas, our state franchise tax is based on income minus cost of goods sold, so it's important to recognize and know what should be in the cost of goods sold area. Okay, finally we have other income and other expense account types. These are on the profit and loss. These are below the line income and expenses, or things that we need to recognize but are not part of our normal business operations. Examples of other income would be sales tax credits for on-time payment from the state, credit card reward point income, gain or loss on a sale of a fixed asset. Okay, examples of other expenses include penalties for late tax payments or fines, like speeding tickets, tax expenses, depreciation, or amortization. Okay, so they're parts of the business that we have to recognize that we have this expense or this income, but it's not actually what we're in business to do, right? We're not in business to sell our equipment. are fixed assets. So if I have a laptop, I use it for a couple years and I sell it on eBay, I'm not in the business to sell laptops, but I do have to recognize my gain or loss on the sale of that asset somewhere. So I do that below the line in other income and other expense account types. All right, now really finally, on your chart of accounts, you might see towards the bottom some other account types, these non-posting account types. So purchase orders, estimates, and sales orders. These are all non-posting transactions in QuickBooks. Okay, you can't post to them, so I can't choose this and say, hey, I'm going to post the purchase orders. It's just where it holds. If I do a quick report, all of my purchase orders are held in that account. So you might see them. If you don't see them, it's probably because you don't have that turned on in QuickBooks. So if you don't use sales orders, again, you can tell that, right? If sales orders is not here on the home screen, then you wouldn't see that on your chart of accounts here as well. Okay, now you can have a better idea of how to set up your accounts in QuickBooks.